Hi everyone, welcome to this live segment. We are going to discuss a bit what's ahead of in this week for the Forex market, both fundamentally and macroeconomically and technically. Sorry. Anyway, let's start taking a look at the main events we have had so far and the ones we have ahead. I was paying special attention to Chinese numbers over the weekend. We have a really poor trade balance, but what seems to be really depressing about these numbers is the sharp decline in export and imports, right? This is a clear sign that the slowdown in the economy continues, and it may extend to others' economy, We always say that once China sneezes, everyone gets the flu. And it's true because China is the one consuming almost most of the commodities that are particularly energy and mining related commodities that are produced worldwide. So if the economy is doing bad in China, the rest of the country, the ones that sell China their commodities and metals, will get in trouble also, right? And indeed, the news were further worse over the past Asian session because we have another decline in inflation, right? From previous 0.1% monthly basis, we are down negatively 0.3%, and producer price indices also fell. So overall, that should keep concerns over the economic recovery high. In the meantime, the U.S. has presented last Friday an overwhelmingly positive employment report, which suggests that the U.S. economy is in better shape, right? And it's the number one economy, and China is the number two. Overall, we should expect further dollar gains, albeit we are seeing some consolidation right now, and the market is looking for a trigger that's not coming. Anyway, and keeping on with the fundamental perspective, I do believe that the most relevant piece of data we have this week in the UK will be the employment figures to be released on Wednesday, right? This is key. If we have better than expected employment numbers in a year, pound can recover some of the ground lost, albeit the background has changed sharply for the pound after the latest Bank of England meeting, right? We were hoping, expecting, speculating the Bank of England was also in the tightening path, and that a rate move in United Kingdom was in the table for the first half of 2016, and all of a sudden in the latest meeting the Bank of England downgrades its raw and inflation forecast and sends the pound catch up with the rest of the currencies in its bearish movement against the greenback, right? I don't know. I believe that this news we have heard last week are pretty much suggesting that there's not going to be a rate hike in the UK during the first half of 2016, and that as the ECB did, the Bank of England is leaving the hard, dirty work in Netherlands' hands, right? They don't want an expensive currency, they don't want to move rates, they don't want to do anything because inflation remains low, and they will continue waiting until the things get better or the US moves and boosts the greenback and put their currencies under pressure, and therefore it will be easier with a cheaper currency to rise rates, right? In the meantime, we are in a wait and see mode. December is going to be here, guys, but we are here. Anyway, we have a speech from Carney and a speech from Draghi also this Wednesday. But I do believe that the Carney one will be the most watched. Draghi has little to add to its latest statement. He said that they will review quantitative easing in December. He already repeated it a couple of times, so no surprises there. The market will be most surely paying attention to Carney and whatever he has to say on a date of a rate hike. Okay. For Thursday, I do believe that Australian employment figures will be key. The Aussie has gave up most of its latest gains, but not all, and in fact is holding pretty well these days, despite the negative news we have seen from China. So overall, I do believe that if we have a bad number in here, we may see the OC capitulating, but overall, but if you take a look at the forecast, we're expecting positive readings. So God knows if it's going to be good. I see some limited upward potential in OC coming from this. On Friday, GDP readings in Europe and retail sales in the US will be the key. I don't know. Retail sales in the US have been pretty weak lately, previous months, I mean. So we need a really positive surprise in here to confirm the US economy is actually recovering and that we may get a boost and more chances of a December rate hike, right? Sorry, I'm getting anxious with those, with that dog barking and barking in the background, but it's in the street. That might not me eye drop, so there's little I can do about it. Okay, let's go to charts and see what we can take out, what can make out of them. Okay, here we are. Sorry for the little interruption. The euro is coming under a limited pressure right now. After correcting the extreme oversold readings we have reached with the 703 we reached on Friday. So, but I know that the bearish trend is pretty much intact, right? The imbalance between central banks and macroeconomic background continues to be the key in here to drive the pair lower, mostly after we break below the 800 level, 840, where the pair has met buying interest ever since late April, right? Those levels have been key, and we break below it and even completed a pullback up to that region this Monday. And right now we're resuming the decline. I do believe that if we lost this 700, we can go down in the short term, of course, towards the 650, 660 region, which is the immediate support. There's little in the macroeconomic calendar for today. There's little triggers, so unless we have a real market mover, some news, I don't see much of a downward continuation in here. But if we lost this one, the next support will be 620, and that's the lowest the pair can go today, right? I do believe that a weekly close below 600 should signal a retest of the year low. We posted around 460, but I'm not seeing a break below 460 before December, right? Before the central bank meetings. Anyway, and also in the short term, the 800, 790 region comes as the immediate resistance ahead of that 840 region, what we discussed earlier. I don't know, we can go up to 900, but really, without really affecting the dominant bearish trend, it will be just corrective, right? The pair has lost over 500 pips in a couple of days, weeks, sorry, right? We lost pretty much, yeah, 600 pips in 3 weeks, all right, following the central banks and the payroll. So I would say that we are going to see some slow-mo movements towards downside before a recovery, okay? And before a recovery, yeah, and that anyway will attract selling interest, okay? Keep in mind that upward corrective movements are still seen as selling opportunities in the euro, okay? As for the pound, the fact is that there's little going on right now with the pair struggling to hold around 51. We have dipped down to close near 150. We have met some buying interest in there. As I said, the change in the tone has accelerated after the strong change in the Bank of England stance, right? The market was really hoping that the Bank of England will raise its rates in the first half of 2016, and all of a sudden it seems that they won't move until 2017, given that they say that inflation won't reach the 2% until then, right? The one target. Anyway, I do believe that the downside is still limited in here, downside is still limited, but the dominant bearish trend it's in place right now, and there's room for further declines down to 48.50 or so if the pair breaks below 150. We are far away from it right now. We have an immediate support around 50.90, 50.50, and then the 50 level. Okay, those are the immediate support for today. If we lost 150, 48.50 seems likely for the end of the week, right? Short term on towards the upside. Take a look at the 20 simple moving average in the 4-hour charts. It's holding around 51.30, where we also have a lot of former highs and lows. So for me, it's a critical resistance. If we can advance above this, we can go further up intraday up to 52. On the week, I don't see much of an upward scope beyond 50 to 60, 70. That's the region I'm looking. That's the level that should attract some interest for me to keep the bearish momentum alive. Okay. Okay. Take a look at the Aussie. There we are. I was looking at this, right? We had a lot of negative news coming from China, and on Monday, Chinese and Japanese share markets, Asian share markets for the most rise. So that kept this pair limited towards the downside. But today, another round of negative data coming from China and stock not performing so well. And anyway, the Aussie is holding in. They are unable to set a direction. It's a bit risky to take a short at this moment, right, with these conditions, because usually with this background, with this macroeconomic background, the pair should have plummeted, right, below the 60 level. So I don't know. This seems to be a bit of suggesting that the downside is a bit exhausted and we may have an upward corrective movement before a new leg south. Okay. For the most, take a look at 70, 20, 70, 30 area. We need to break that support to confirm additional declines in the short term. I do believe that this area around 69.90, 69.80 is the immediate short-term support, but once we take out the 70 level, we can go down to this region, 79.30, and even retest the lows around 69 in route to 66 later before the year's end, right? The upside, it's also looking a bit, she made it at this time. 70.70 is for medium near resistance, and we need to advance above it to see some follow through towards 71. Still, the line in the sand for me to the upside is far, far away. It's around 70 to 40. And this is the level that the pair needs to recover to turn mid-term, long-term bullish, right? In the meantime, and at this level, I'm not seeing much of an upward potential besides intraday. Okay, limited. One thing that I'm watching is the strong bearish momentum we're having in stocks, and we have both oil and gold neutral, completely neutral ever since the week started. So another warning that maybe the dollar rally needs to get corrected before resuming. Anyway, and for the dollar Japanese yen, the weekly picture is pretty much the same, pretty disappointing price action so far these 2 days. But overall, the bullish tone prevails. If you take a look at bigger time frames, not only the dollar Japanese yen, but in almost every single cross you will notice, or pair, you will notice that the technical indicators have been correcting extreme readings reached lately, and that's it. Not giving clear signs of direction, but while the extreme oversold readings are being corrected, the price is consolidating in range. So it's a phase in the market, okay, where we are looking for direction that could end anywhere, anyway, meaning it can end with a strong bearish movement in the greenback, or the American dollar regaining its strength and pushing to fresh highs. So for now, it's a wait and see stance. Anyway, I'm taking a look at the daily chart. There is some resistance around 23.18 here. I believe that's the level to watch. Take a look. We have plenty of highs and lows around that level. So I could like some follow through above it to talk about further gains. 24.40 comes as the next probable target for me, and above this 24.40, 50 area There's not much in the way up to the year high around 25.80. Honestly, I'm not expecting this level to give up again before the December Fed meeting, right? I'm still doubt what market reaction will be then, whether if the Fed rises rates or not. Anyway, that's the level to watch, and that's the probable bullish target, although I'm not expecting it to be reached this week. Okay, and so at this point, dips towards what was the roof of a previous range around 2130, 2170, right? In between 2130 and 2170. Pullbacks towards that level should be considering as buying opportunities rather than signal a bearish breakout in the currency. On the contrary, I believe that the dollar will continue ruling the market. Okay, I don't know if there's something else I can take a look at. Okay, gold, yeah, all gold, right? Gold has plummeted for almost 10 days in a row. And so far, the upward corrective movement had been pretty limited. In fact, we have just yesterday the commodity adding a couple of bucks. So for the most, I don't see a real upward potential in here, but beware of corrective movements, okay? The 11 area, 11.05 is the level to watch, because I believe that we may get a pullback back to that level, but to that price zone, but that's it, okay? I still believe that the short pacing here, and that we may retest those lows around 1071 before the year end, okay? Okay, I will turn off my camera. There was a little disconnection. It seems that my internet losing, but anyway, thanks for being here. Thanks for sharing this time with me, and see you back soon. Okay, see you. Bye bye.